Minimizing taxes in retirement is on every retiree's mind. So I'm about to show you how you can pay no taxes in retirement during a unique period of time called your gap years. And be sure to stick around to the end because I'll do a Q&A at the end of the video to help everything make a little bit more sense. But first, if I haven't met you yet, my name is Jacob Duke. I'm a certified financial planner and the owner of a retirement planning firm built to help people just like you plan smarter and retire better. And the biggest question that every new client has for me is, Jacob, can you please help me figure out how to plan for taxes in retirement? I know that if I don't do anything, I'm going to get killed in taxes throughout retirement. And this question is likely on your mind too. So let's walk through how you can use the tax code to your advantage early in retirement to reduce your taxes during the current year, but also in years in the future. All right, so let's look at an example and walk through this and go through some scenarios. Let's assume a few different things. First of all, let's assume that you have $1 million in an IRA. You've got $250,000 in a brokerage account. You've got no Roth, at least at this point. You have no debt as well. Your house is paid off or you have no mortgage there, or you're just renting. Let's assume also in this scenario that we're married, filing jointly, we're not single, and we need about $5,000 a month to meet our basic and normal expenses. So that might be close to your scenario or might not. Either way, the principles we're about to walk through are going to be helpful, hopefully, as you apply them to your situation. So here's a couple things. Let's assume that we say we've got $5,000 a month that we have to meet our normal retirement expense needs. Now, in order to do that, we have the option to pull from a couple different places. We can pull money from our traditional IRA, which currently has $1 million in it, or we can pull money from that $250,000 brokerage account. Now, we're also going to assume, at least at this point, that Social Security is not turned on. Again, we're in the gap years phase of life, which if you want to know what the gap years are, you can stick around towards the end of the video. I'll answer more about that in the Q&A section of the video. But what we'll do is we'll just assume no Social Security. So we have to pull money from our portfolio, no other fixed income sources like a pension at this point. We're going to say we're 60 years old, okay? So we need $5,000 a month, $60,000 a year. Where do we pull from? First option, we could pull money from our traditional IRA, at least all of that. So $60,000 can come out of our traditional IRA. Now, in order to do that, we will have to pay some taxes, and here is the scenario. So we're 60 years old. $60,000 is how much we need. In order to do that, let's assume we take all of that from the IRA. Now, in 2025, the standard deduction for a married filing jointly couple is going to be $30,000. So minus $30,000, that is technically what I call the 0% tax bracket. So that's what we call the standard deduction. That leaves us with $30,000 left over. This is what is going to be what's called your taxable income. This is going to be run through the tax brackets. And you can see here on screen, as married filing jointly, the first tax bracket is at 10%, and that is $23,850. So I'm going to do a little bit of math here to help us walk through this, but 30,000 minus 23,850 equals $6,150 that's left over. That 23,850, that is going to be taxed at 10%. So what we can do is we can just take a zero off the end of that, and this right here is going to be 23,850. That's our taxable amount on that at 10%. This is just federal level. We're not considering state income taxes if they do apply to you, but you'll have to factor that in, separately. This leftover amount, the 6,150, that is going to be at the 12% bracket, and that's what would overflow or waterfall into that or go into the 12% bracket there above 23,850. So 12% on that amount equals 738. We add those two numbers together, and that equals 3,123. So $3,123, that is how much tax we will pay in 2025 if we have no other income and only pull $60,000 out of our IRA. If we divide that by 60,000, our effective tax rate is 5.2%. So effective tax rate of 5.2% on $60,000 out of a traditional IRA. So that's one option. You could do that, which is overall a really low tax rate, especially if you compare that to what you were paying while you were working at 10, 12, perhaps 22% at the marginal level or even higher. So 5.2% is a really low tax rate. So that's the first way you could get your $60,000 is pull all of it from your traditional IRA. Now let's move to the second way that we could pull that $60,000. So we're going to start back over here at $60,000. But instead of pulling that money from the traditional IRA, we're going to pull that money from the brokerage account. So we have $250,000 there. And for the sake of this scenario, let's also assume that about half of that amount half of 250 is actually the gains, and the other half, the other 125, is going to be the principal, what you contributed to the account over time. So it's doubled in value over the amount of time that the account has been there. And we have to assume a few different things here just to keep it really basic. I know that not every share has gone up by doubled and gone up by 100%. We're going to assume that that's the case in this scenario. So we're going to assume that every single dollar we sell, half of that amount is actually growth. The other half is return of principal. I know it doesn't work that way, but for the sake of argument here and the example, we'll assume that. So if we have to pull $60,000 out of this $250,000 brokerage account, we would be left with $190,000. But in order to get that $60,000, we have to sell the investments that are in that brokerage account. And again, we're going to make another assumption. We're going to assume that the investments have been held for over 1 year, so they qualify for long-term capital gains, okay? So if we take $60,000 out of that brokerage account, that means that only $30,000 is subject to taxation, and then the other $30,000 that makes up the full $60,000 we're taking, that is return of principal. That is your original investment. So what we've got there is $30,000 is actually subject to taxation, but it is a long-term capital gain. And I've done a previous video on this in a little bit more detail around long-term capital gains taxation, how you can do what's called tax gain harvesting, which I'll talk about more in the Q&A section again of the video. But right here on screen, you can see the long-term capital gains brackets. And the unique and beneficial part of long-term capital gains is that there are 3 different brackets and there's a 0% bracket. So the first, if you're married filing jointly, the first $96,700 of taxable income, okay, that amount would actually be in the 0% long-term capital gain bracket. Now, just so we're clear here, if you only have capital gains, meaning no other income, you can have $96,700 of capital gains that are long-term, and that would be at 0%. Now, if you have other income, let's say from a part-time job or a distribution from your IRA, which we'll go over in just a second, you will have to add your capital gains on top of the other sources of income. So it stacks on top of each other, all of different sources of income, and it can be complicated. So if you want to learn more about that in more detail, go watch that other video that will be linked down in the description below. But in this scenario, again, we have no other income and our only source is money out of the brokerage account. So $30,000 is the taxable portion of the $60,000 that we've sold in the brokerage, and now that is going to be long-term capital gains. So $30,000 is less than $96,700. Now, again, that $96,700, that's the taxable income that is in play here. This does not include your standard deduction, which would have to be added on top in addition to that 96. So really, $126,000, almost $127,000 is how much room you have to play with if you use a standard deduction and you're married filing jointly. So all that to say, we are well within the 0% capital gain bracket here for the long-term capital gains, which means we get all $60,000 out of the brokerage account completely tax-free because the $30,000 of growth will be at that 0% rate. So that means no taxes if we pull money, all of the money that we need this year out of our brokerage account. So those are 2 different ways right off the bat that you can pull money. Now, most of the time, the standard rule of thumb is to say, let's use all of our brokerage account first, or what we call a taxable investment account. And then we'll go to our tax deferred money like a traditional IRA second in terms of the order that we distribute money out during retirement. Now, that's fine, but here's the problem. You're not taking advantage of that standard deduction. You're not taking advantage of the 0% long-term capital gain bracket, at least to its fullest potential, because you're not filling it all the way up. So what I wanted to present to you is this. What if we took money from 2 different sources here? What if we took money from the traditional IRA, at least in part, and we took another portion of money from your brokerage account, and we're still going to pay no tax on any of it? I'm going to show you how. Let's assume that we need $60,000 again. Okay. Let's say we pull $30,000 from the IRA. And let's say the other $30,000 actually comes out of the brokerage account. That first $30,000, guess what? We're going to use our standard deduction, $30,000 here in 2025. So technically, none of that money is going to be subject to taxation. It is taxable money. It goes on your AGI, but the standard deduction helps cover it. So $30,000 out of your IRA is completely tax-free. Now we have $30,000 left that we're going to have from our brokerage account to meet our full $60,000 that we need for income. But remember, since half of the brokerage account is actually the original investment, the other half is the growth, that means out of that $30,000 from the brokerage account we're taking in this scenario, only $15,000 is taxable as a long-term capital gain. So that $15,000 is capital gain, okay? So we don't actually get $30,000 of taxable gains out of the brokerage. Half of that's principal. That means $15,000 on top of the $30,000. $15,000 is well less than $96,700. So what you've got here is you're going to pay no tax on the IRA distribution because the standard deduction fulfills and meets that and basically erases it from your taxable income. The $15,000 left over, that is a long-term capital gain, and because that's less than $96,700, you are going to pay no tax on that because it's at the 0% rate as well. Means you got $60,000 out of your accounts in combination with each other for no taxes to be paid. But here's the real cool part. The IRA, traditional IRA, you put the money in originally in a tax-deferred way. You deferred your taxes into the future. You did not pay tax whenever you earned that money while you were working and put it into that tax-deferred account. But here's the catch. Whenever you take money out of a tax-deferred account like an IRA, you are supposed to pay income taxes at that point. That's the whole idea. Tax deduction on the front end, you pay taxes later. Well, based on how we constructed the income in this scenario and how we stacked them together, your traditional IRA turned into a Roth IRA simply because of how we structured the income. It's not because we evaded taxes. What we did was we just used the tax code to our advantage, and most people are overlooking this because they're following those standard rules of thumb where you would take from your brokerage account first and your IRAs second in terms of the orders of distribution throughout retirement. So I wanted to show you this because here's the thing. You can generate income from your portfolio completely tax-free, especially when you don't have Social Security turned on and you don't have a pension. Obviously, you can change these numbers. You can increase how much money you need. In fact, let's go ahead and do that. Why don't we just say we need $100,000 okay, out of our, for income for the year. We still have the same portfolio. What we can do is we can take the first $30,000 again out of the IRA, okay? And that's going to be no tax again because we're going to use the standard deduction for that. That leaves $70,000 left over, right? Let's assume that we take all $70,000 out of the brokerage account. Out of that 70, again, half of that amount is the long-term capital gain portion, so $35,000. And since, again, that is less than $96,700, guess what? We're not paying tax on that either. So there's $100,000 that's going to be coming to you as income for retirement, completely tax-free, a portion from an IRA, the other portion from your brokerage account. Now, here's the interesting thing about all of this. You have to have that brokerage account in place with potential gains there to do the strategy and take advantage of it. If you don't have a brokerage account and you only have an IRA or any sort of tax-deferred 401k, you really don't have options because the only place to pull money from is going to be that tax-deferred account. So this brings up an important point about tax diversification and why it's so important to retirees in terms of the ability to lower your taxes. I like to have money in 3 different buckets. The first bucket is going to be tax deferred. That's where most people save throughout their careers. It's typically the heaviest weighted out of someone's overall portfolio. The second bucket is going to be tax-free like Roth, and we don't have Roth included here in this scenario. Typically, you want to let your Roth grow as long as possible, although there are moments and periods of time throughout retirement where you might want to use it a little bit sooner because it is tax-free money. It is there to be used, and you saved it into the Roth and you got it there so that you could have tax-free income in retirement. So I'm not always saying just push Roth distributions forever into the future so that it can grow as much as possible, although mathematically that is the smartest thing to do. What I'm saying is you could find different opportunities throughout the early stages of retirement to use your Roth in strategic little pockets or scenarios. And then finally, the third bucket in terms of tax diversification is going to be that taxable brokerage account, which we've seen here. You can have what's called qualified dividends. You could have long-term capital gains, which are more favorable from a tax perspective. Obviously, this scenario doesn't factor in dividends or interest from the brokerage account or from bank accounts, but you would have to add those into this scenario to say, hey, we have $5,000 of qualified dividends. Yes, they're going to be taxed at 15%. You can't offset or use those in that 0% long-term capital gain bracket. They don't do that. But the key there is that you'd have to add them in so you'd have a little bit less money that you could sell in the brokerage account if you were even getting close to that top of the 0% long-term capital gain bracket, but we weren't in this scenario, so dividends and interest weren't really a concern. If they were, you have to factor them in. So know that I understand that and that dividends and interest are a part of everyone's portfolio, and typically people are going to have those. Didn't factor them in here today because we weren't even getting close to the $96,000 top of the 0% long-term capital gain bracket. But one question that might come up in a lot of people's minds is going to be, Jacob, what if we just took money out of our brokerage account and did a Roth conversion with money out of the IRA up to the standard deduction so that we get tax-free money into the Roth IRA through the Roth conversion because we're using that standard deduction, and the rest of our income, the $60,000 we really need, is going to come from the brokerage account. And guess what? Here's the thing. We can do exactly that. So let's go back to our first scenario where we needed $60,000. Now, what we can do is this. Let's say we were going to do a $30,000 Roth conversion. We're going to take the other $60,000 out of our brokerage account using long-term capital gains and tax gain harvesting. Well, really what we'd need, if we need $60,000 of income, we'd have to actually make it $90,000 total, right? Because $30,000 of that amount is actually going to be Roth conversion. So what we would do there is to get $90,000 of total income on our tax return, $30,000 would be IRA conversion, okay? And then the other 60 that's left over, that's all going to come from the brokerage. And what we're going to do there is out of that 60, $30,000 is actually subject to taxation. That's the capital gain portion of this. So again, if we add that 30, that's $60,000 of total adjusted gross income. Again, we'd have a standard deduction of $30,000, which offsets the IRA portion. And then we just have $30,000 left over, which leaves us with our brokerage account capital gains. Again, that's still less than $96,000 of taxable income at the 0% rate. So again, we pay no tax on our income that we spend, the $60,000 out of the brokerage account, and we're paying also no tax on the IRA conversion itself. Again, that's a power move. That's something that most people just don't even think about whenever it comes to Roth conversions or tax planning and retirement. They think they have to pay taxes, but what I'm showing you here is, again, if you can structure your income in a certain way, if you can think about and strategize how and where you're pulling money from, especially early on in retirement, and you have options, tax diversification, you have money in different buckets, Roth, brokerage, and also traditional IRAs, you have the flexibility and the optionality to use these strategies to your advantage. So I hope that was helpful as you understand more about how to build your income streams and how to do tax planning and retirement. Let's go ahead and jump into the Q&A section of the video. All right, the first question is, what is tax gain harvesting, and can I do this as a single tax filer compared to married, filing jointly like you explained in the video earlier? And the answer is tax gain harvesting is intentionally selling something within your brokerage account that has gone up in value once you've held that asset for longer than a year so that you can use that 0% long-term capital gain bracket. So you are intentionally selling something on purpose that's gone up in value. Now, this is the opposite of what most people have heard of, which is called tax loss harvesting, where you're intentionally selling losses, trying to offset either normal income up to $3,000 any given year or other capital gains that you might have there as well. So out of the two of these, tax gain harvesting is my favorite compared to tax loss harvesting. Tax loss harvesting has its advantages and can be used especially if you're in high income periods of time or have a lot of capital gains that you need to offset. But what I would say is this, tax gain harvesting allows you to basically turn your brokerage account and the gains that have happened there into a Roth IRA so you get completely tax-free money that gets to you. And here's the thing, whenever you do tax loss harvesting, you have to wait at least 30 days before reinvesting in something, either the same security or something similar. With tax gain harvesting, you don't have to wait at all. You could sell your position, whatever it is, let's call it Apple stock. You could sell it today and buy it back today or tomorrow. And there's no issues from a legal standpoint because you're actually paying taxes on the gains. It's just that it's going to be at a 0% capital gain rate. So that's what tax gain harvesting is. Now, can you do this as a single tax filer? And the answer is yes. You would just have to use your specific bracket. So right here on screen, you can see that as married filing jointly, which we looked at earlier, the first 0% bracket at long-term capital gain rates goes up to $96,000 and change of taxable income. But for single folks, it's $48,350. So just divide that by 2, and then that's how much applies for you as a single filer. Obviously, you go into that 15% bracket there as well, but that's how you would do it. The same principles, the same ideas apply, but your tax brackets are compressed a little bit as a single tax filer. The second question we already talked about briefly, but what is tax diversification? Jacob, I heard you mention that earlier and talk about that. Tax diversification, again, is having optionality in terms of where your income can come from in retirement and the taxes associated with those income types. Tax deferred accounts always have to fall as normal income on your tax return. Tax-free accounts like Roth IRAs are always tax-free once you're 59 and a half and the account has been open for 5 years. Although you can access your contributions to a Roth IRA completely tax-free regardless of your age or how long the account has been open, you can always get your principal back. But your brokerage account, that's the final one there. That one qualifies for qualified dividends if you have stock holdings in that account, but also long-term capital gains as well. So having 3 different buckets to pull money from in retirement gives you a lot of flexibility and allows you to make decisions and create strategies that optimizes your tax plan throughout the rest of your life. So tax diversification, if you have not got this in place, if you haven't saved the different account types and everything's in a 401k that's tax deferred or a traditional IRA, if you're still working, I would definitely recommend focusing on finding ways to save or get money into those other brackets so you have options when it comes to retirement. Now, then this leads into the next question, which is, what if I don't have a brokerage account? Well, I would say start funding one if you can. Maybe reduce how much you're putting into a tax deferred 401k and start saving anything above your match into a brokerage account. So again, you have options when you get to retirement. Now, if you don't have this brokerage account while you're working and you're retired already and you still don't have a brokerage account, it might not be a way for you to really get money into it. So you're kind of where you're at. There's not much you can do there. What you could do instead maybe is actually convert money to a Roth IRA, and that could be beneficial for you in the future and later years of retirement whenever you have tax-free income to pull from. And it could also help lower your future RMDs because your tax-deferred account balance is lower. And the final question we'll answer here today is, how do I know if I should be doing Roth conversions or not? And this is a different answer for every single person out there because it depends on your circumstances. It depends on your goals, what you're trying to achieve. Do you have legacy that you want to leave in terms of financial legacy for your heirs one day or not? How big is your tax deferred account balances? All these things are in play and the answer is different every single time. But here's what I would probably say. No matter what, you want to at least fill up that 0% normal income bracket, which is the standard deduction. So based on the example we gave earlier, we had the opportunity to do that. So we converted up to the standard deduction amount. So that's a Roth conversion at 0%. We're using the other brokerage account for income for our normal living expenses. So that's the first thing I'll say is no matter what, if you have it available and you haven't filled it up yet, fill up your standard deduction with a Roth conversion. Now, here's the next thing. I would probably say go even further to fill up the 10% or even the 12% since those tax rates are extremely low, at least historically. We don't know if tax rates are going to increase or not, but they are really low, at least in those first couple of brackets right now. So think about filling up those first two brackets at a minimum, but maybe something else to think about is around your account balance. If you have less than $1 million tax deferred, it might not be helpful for you to do a Roth conversion because your RMDs will not be overly large anyway. Now, if you have $1 to $2 or $3 million, you should be evaluating Roth conversions for sure. If you've got $3 or more million, it's probably safe to say you need to have at least some sort of tax strategy in place, and Roth conversions could play a big part of that. So think about that. You've got to understand your situation and see where your opportunities are. You might not have the opportunity to do Roth conversions. And here's what I'll say too about single tax filers. Typically, single tax filers are going to struggle to do Roth conversions and actually benefit from them. So if you're single trying to do Roth conversions, I would be cautious. I would make sure that it actually does make sense, run a lot of scenarios and a lot of projections to make sure it works for you. Married filing jointly, folks, Roth conversions are awesome for you because the tax brackets are so much larger. So I hope these questions and answers help you as you continue on your retirement planning journey. Thanks for watching this video. We will see you in the next one.